The Reserve Bank of India's rate hike in May, in order to be in line with the global market sentiment, has pushed the domestic currency to record low levels. The rupee has skidded over 2% against the US dollar in May, in its worst monthly decline in 2022. By comparison, the S&P BSE Sensex and the NSE Nifty 50 have tanked over 3% each during the period. Weak economic data, rising interest rates, soaring inflation, and exit of foreign investors are some of the key triggers behind the rupee's meltdown. That is because a depreciating rupee does not bode well for foreign investors as returns reduce from Indian investments, prompting their departure. According to data provided by Jefferies, foreign portfolio investors have sucked nearly $5 billion out of Indian equities in May so far. Moreover, a falling rupee expands the deficit maths of an import-oriented economy like India. As our economy is heavily dependent on crude oil imports, a weaker rupee as well as higher crude oil prices weighs on the current account deficit. It also presents the risk of imported inflation. Remember, a heavier import bill along with a weaker rupee widened India's deficit to $20.7 billion in April from $18.5 billion in March. According to a report by S&P Global Market Intelligence, India's oil import bill hit a record high in April as it surpassed 4.8 million barrels a day. Against this backdrop, analysts believe that import-dependent companies will bear the brunt of a sliding rupee, especially when the input costs are on the rise.
The country as a whole, clearly our trade deficit is primarily owing to our import bill, and which comprises largely of import of crude oil. And when pricing over there kind of goes up, and with the depreciating rupee, so the cost gets transferred, to the clients, to the economy in general. And a function of that is to see the inflationary trend rising, and that's why we've seen the kind of increase in inflation of late, right? And so to companies which have which basically largely import dependent for creating the final product, are companies which are going to be significantly impacted. So for a company which kind of imports material to then create a finished good to be exported, there obviously there'll be a neutralizing impact, right? Because obviously the import costs would have increased, while there's an appreciation on the export side of it, it kind of gets neutralized because of the higher import cost, and not to forget the inflationary trend in general for all input costs.
According to a report by ICRA, the Indian rupee could trade in the range of 75 to 79 per dollar in the first half of FY23. A rise in the current account deficit, along with monetary policy tightening, dollar strength, and risk aversion towards emerging markets, is expected to impart a depreciating bias to the Indian rupee. However, large forex reserves, narrowing inflation differentials, and the likely stemming of FII debt outflows would prevent a further depreciation. That said, a weaker rupee offers a silver lining for the export-oriented sectors. Analysts believe that IT, pharma, textiles, and specialty chemicals could gain a competitive edge amid a sharp decline in the rupee.
Farly going to benefit the IT sector, the pharma sector, the textiles, and the specialty chemicals. It all depends on the global demand pickup that could happen. The rising input costs would probably have a neutralizing these gains, but not for the IT service sector or a labor-intensive textile sector, but the rest of the export-oriented sectors, which would also have an import intensity very high. For them, this could be an impact on the rising input cost. On the weaker side of the sectors which could be seen on the rupee depreciating is the automobile, capital goods, petroleum, power and telecom sector, which would not gain anything on this. They will have to bear the brunt on the weaker side of the rupee.
Overall, with rising interest rates and weak global macros, there's little room for optimism for the domestic currency. On Tuesday, markets will track GDP data for the March quarter of 2022. Globally, Eurozone CPI data and the UK's consumer credit data will also be on investors' radar.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.